Here are the Unit 2 notes on banking for consumer economics. The economic system could not function without financial institutions. These institutions are our financial go-betweens. They keep money flowing throughout the economy among consumers, businesses, and governments. So we're going to first look at some of the types of financial institutions. First, we have a commercial bank. Commercial banks are banks owned by stockholders and operated for profit. Its primary functions are to receive, transfer, and lend money to individual businesses and governments. Commercial banks are often called full-service banks. They offer a wide variety of services. These banks may be chartered by the federal government or by the state government. The biggest thing to remember is that commercial banks are for profit, so their purpose of existing is to make money. The Federal Deposit Insurance Corporations, or FDIC, is a government agency that protects bank customers by insuring their deposits. It also examines and supervises financial institution policies and operations. The goals of the FDIC is to help maintain consumer and business confidence in the banking system by insuring bank deposits. This guarantees that depositors are protected if their bank fails or cannot repay deposits on demand. Currently, the FDIC insures $250,000 of a customer's total deposits in a given bank. This is something that you're going to make sure that you remember because it does appear on the test. The FDIC insures $250,000 of a customer's total deposit in a given bank. The FDIC was developed after the Great Depression, where people lost a lot of the money or any money that they had in the bank when the stock market crashed in 1929. So after that, the FDIC was formed in order to protect people's money that they had in the bank. Credit unions are a different type of financial institution. They are non-profit financial cooperative owned by and operated for the benefit of its members. Its services are offered only to members. Membership is available through affiliation with an employer, a union, a religious organization, a community organization, or some other group. So in order to be a part of a credit union and be able to participate, you have to have a membership with some type of group. So for example, the Abri Credit Union that's downstairs by the cafeteria is a credit union. And we all are able to be a member within that credit union because of our affiliation with Joliet Township High School, among other reasons why we may be able to affiliate with them. A lot of people like credit unions because of that non-profit aspect. They feel that credit union is going to be someone that looks out for the consumer, which is definitely often the case. Newmark Credit Union is another popular credit union in this area. Since credit unions are not-for-profit organizations, they pay no federal income taxes. Members often run them, and operating costs may be relatively low. Because of this, credit unions can lend funds to members at slightly lower rates than other financial institutions. So for example, if you have a loan that you get through a credit union, oftentimes that interest rate on that loan is going to be lower than if you were to go to a commercial bank, like a Bank of America or a Chase or a Harris. Today, larger credit unions offer most of the services bank and other financial institutions provide. Credit unions may be either federally funded or state chartered. The National Credit Union Administration, or NCUA, would be that organization that grants federal charters and supervises credit unions across the country. They also insure deposits in all federally chartered and many state chartered credit unions, just like the FDIC insures money that within commercial banks. So there's a couple different financial institutions, main types that are out there. So what's important as a consumer is that you choose a financial institution that works for you. Consumers usually look for checking, savings, investments, and credit services at whatever financial institution that they choose. Before opening an account, it is best to do some research. So for example, what are some things that you should consider when choosing a bank? Most of you all probably chose the bank that you may be banking at now simply because your parents were already banking there, which is a good enough reason to choose it. There's that familiarity. If your parents have accounts there, they can move money from their account into yours perhaps, and things like that. Also, you want to consider like location. Although it's not quite as important as it was in the past, you still want to be able to have a bank that you can access easily if you are the type of person that wants that face-to-face service. And you also want to look at things like the fees charged, the options they have in terms of services within that bank, and things like that. Before opening an account, you want to find out if the bank institution is insured by the federal government. A sign stating insured by the FDIC or insured by NCUA should appear by the front window or near each teller station. Services of a financial institution. Today, many of the services offered by financial institutions are provided through electronic funds transfer. I would say that most services that are done through financial institutions, whether it be a credit union or a commercial bank, are done through electronic fund transfers, or EFT. And that is the movement of money electronically from one financial institution to another. An ATM, or automated teller machine, is a computer terminal used to transact business with a financial institution. How many of you all even realize that ATM stood for automated teller machine? An ATM card allows customers to withdraw cash from and make deposits to their account using an ATM. And a personal identification number, or PIN, is a number used to protect account information for an ATM card. So that PIN number is used when you go to an ATM to withdraw money, and then anytime you are doing a transaction with that debit card or ATM/debit card at a store, you would have to put that PIN number in order to access or to make that purchase. Direct deposits or withdrawals. Customers using this service can arrange to have paychecks, Social Security checks, and or payments deposited directly into their accounts. They can also pay bills without writing and mailing checks. Recurring bills such as car payments, insurance premiums, utility bills, and others can be automatically paid as well. Money can be transferred from a checking to a savings account each month, creating an automatic savings program. All of these transactions are recorded and included in monthly bank statements. So whether that be that bank statement that you get in paper, if it gets mailed to your house, or like most of us probably use now, statements that can be seen online in regards to your transactions for that month or so. Point of sale transfer, POS, refers to the place the transaction was made. So a point of sale transfer occurs when you move money from your account to pay for a purchase. This requires the use of a debit card. This allows you to make purchases without checks, cash, or credit. So this is basically like when you use your debit card and you scan it, and you take a look at your bank statement, and it shows like exactly where you spent your money. So not just where, like, or what store, but it also gives information about the address and things like that. Online banking services. Now there's pretty much, you can do majority of your banking online. The things that you can't do online is anything having to do with actual cash, right? So if you got money and you needed to deposit it, or you needed to get cash out of your account, you would have to at least go to an ATM or a teller, but pretty much everything else is online. So online banking allows customers to do the following: check their account, review their account history, arrange and schedule electronic bill payment, and confirm any direct deposits, withdrawals, or transfers. So pretty much any information that you need to know about your account would be able to, at this point, of course, you can find online. Overdraft protection. What overdraft is the act of writing a check for an amount greater than the balance of the account. So say you went to McDonald's and your purchase was $5.45. If you only have $5 in your account and you slide your card to pay for that McDonald's and you don't have that extra 45 cents, you are going to be charged an overdraft fee. With Overdraft Protection Service, however, if you have it, a financial institution will honor your check written by you even if it exceeds your account balance. Typically, banks charge a $25 or higher fee for your overdraft. I think the average overdraft fee is about $36. Keep in mind, that's $36 for each time you attempted to use that card. So you have, you went to McDonald's, you overdrafted, that was that $36 fee. And then you went to Target and you overdrew again on the same day. That's another $36. And that's going to continue as long as you're trying to use your card and you don't have you have insufficient funds in your account. Stop payment, that just means that if you were to have given a check to someone and you do not want them to be able to cash it, you can pay what's called a stop payment fee. Usually people do this like if they lose a check or if it's stolen, and it can be quite expensive. So if you do decide to do this, you have to make sure it's worth the cost. A safe deposit box are boxes available in the vault of a bank for storage of valuables such as jewelry, birth records, etc. Financial counseling. Most financial institutions, whether it be a credit union or a commercial bank, have some type of financial counseling. And that's just services such as a trust department, tax reporting assistance, or financial planning. And then drive-up service is, when you go to the bank and you're able to drive up and communicate with the teller while still being in your phone. Still being in your car. That's drive-up service. And then mail-in service refers to what's probably not nearly as popular now, but just doing your banking by perhaps mailing your check into the bank and then letting it deposit. Now with the internet, we really don't use that mail-in option very much. Features of personal checking accounts. First of all, there's always going to be restrictions and penalties. So you want to make sure you ask about things like, is there a minimum balance required, withdrawal limitations and penalties for overdraft or late payments on credit accounts. And then other fees and charges you want to make sure you're aware of. So you want to ask about those fees and charges that are associated with the type of account that you have. So for example, I have a Bank of America account where my minimum balance has to be $1,500 or else I am charged anytime I drop below that balance. So some of those fees include maintenance fees, charges for ATM use, especially if you're using an ATM that does not belong to your bank. Low balance penalties, that's kind of like what I was just talking about with my Bank of America account. Check writing fees and check printing fees. Higher minimum balance accounts usually reduce or eliminate those fees. Interest rates, you want to make sure you compare them. Compare interest rates on interest-bearing checking accounts. A lot of times those accounts are known as money market accounts. In addition, examine the areas charged to borrow money or use a bank credit card. Convenience services, of course, you want to look for a financial institution that has convenient hours, ATMs in various locations, online banking, and credit cards. Most financial institutions that you're going to encounter now are going to have those basic things in terms of availability of things online. So you have to just decide what's going to be important for you when making that decision. Some of the different type of checking accounts would be a basic checking account. This allows you to deposit and withdraw your money and write checks. Usually requires a minimum balance to avoid service charges. There may also be a monthly service charge and a fee per check. An interest-bearing checking account. This is a combination of savings and checking account. Your money earns interest and you can write checks on the account. And then a lifeline checking account. These are relatively new and are intended for low-income customers. They feature low minimum deposit and minimum balance requirements, low monthly fees, and limits on the number of checks that may be written per month. All right, let's quickly look at some of the different types of checks that people use. A personal check. This is a check that is used to make a payment out of your checking account to companies and or individuals. So this is what just the basic check that you would have access to from a bank based on having a checking account with them. A cashier's check is drawn by a bank on its own funds and signed by an authorized officer of the bank. The bank is able to guarantee payment of that cashier's check. Some businesses or people may require you to pay them using a cashier's check, just because it's you can trust it more than a personal check, because the bank is backing up the fact that this check is going to cash and that money will be there when you cash the check. A certified check is a little bit different. It is considered a personal check, so it's considered a personal check, but it has the bank's guarantee that the check will be paid. So you do have to actually go into the bank to get a certified check, but it's backed up with the money that you have in your account, and then the bank guarantees that yes, you do have this money in your account. When a bank certifies a check, the amount of the check is immediately subtracted from your account. It's used to make a payment to a payee who does not accept personal checks. So for example, when we bought our house, we had to have a certified check to bring to closing because for number one, the large amount that check had to be, and then number two, just to show like, yes, we have this money in our account. This is what we're going to be paying. That money is going to be backed up when you cash the check. A money order typically does not actually come from a bank, but a money order definitely has a purpose and a place. It is an order for a specific amount of money payable to a specific payee. People who do not have checking accounts may use money orders to send payments safely by mail. They are sold at financial institutions, U.S. post offices, and other convenient locations, and typically there is a fee associated with doing a money order as well. All right, ATM/debit cards. We talked a little about them. Let's talk a little more. The ATM card allows you to get cash back from your account at any time. ATMs are like everywhere. So, of course, at a bank, you can find ATMs at malls, airports, grocery stores, and at other convenient locations. Keep in mind, generally you may use an ATM owned by your bank at no charge, but there is usually a charge for using the ATM that is not affiliated with your bank. Okay, and let me add that depending on what type of ATM you use is going to have a lot to do with that fee that you charge. So for example, it's all about convenience. So if you are at a place where they maybe only accept cash, more than likely if they have an ATM in that area, you're going to be charged a pretty hefty fee for using that ATM because it's all about supply and demand. Your ATM card will come with a PIN and that is used in order for you to access your account. Typically now, an ATM card is going to be combined with your debit card, and they're all together. So like I just mentioned, a debit card is typically combined with an ATM card. You can use your debit card at ATMs and any businesses that accept credit cards. When you make a purchase, you swipe it through an electronic scanner, then enter your PIN to authorize the payment. When using a debit card, the purchase amount is immediately subtracted from your checking account. So when you use it, it processes immediately. That's something that you're going to see on the exam as well, so make sure you have that correct. So you are unfortunately in a situation where your ATM or debit card is slowing. What do? Well, under the Electronic Fund Transfer Act, or TFTA, your liability for unauthorized purchases depends on when it was reported. So, if you report it before any unauthorized charges are made, you're not going to be charged anything because obviously no one even tried to use your card. If it is within 2 business days after you learn about the loss or death, your maximum loss is $50. Now, if you only had $25 in your account, then obviously your maximum loss is going to be that $25. if you report it more than 20 business days after you learn about the loss or theft, but less than 60 calendar days after the statement was sent to you, then you're going to owe maximum $500. Once again, if you do not have $500 in your account, you're not going to all of a sudden owe $500. It's just the maximum. And then, if you report it more than 60 calendar days after the statement is sent to you, all the money taken from your ATM and debit card account, and possibly more, for example, money in accounts linked to your debit account, you are liable for that loss. So the bottom line is, if you ever find yourself in a situation where your debit card is lost or stolen, you need to report it right away in order to minimize how much money you owe and potentially how much money you may lose. And that is the end.